Oh yeah. All right, guys. So we have lists, tuples, sets, and dictionaries. You're probably wondering what any of that has to do with a trading platform. Well, the answer is absolutely nothing. I'm just so excited to see yesterday's lecture still visible on the board, but today we're going to talk about a trading system architecture. So what exactly is a trading system? I'm going to break it down piece by piece to let you know all of the various elements that make up a trading system. This is Carlisle Speaks Wall Street. Vigets. Dobre utro. Buenos dias. And let's begin. Oh, wow. I guess this oh. 1 second, guys. I don't think that magnet's been moved in a very long time. So let's talk about a trading system. What is a trading system? What is its purpose? And what's under the hood? So first of all, what is the purpose of a trading system? What types of technology are involved in a typical trading system? And what are the components that make up a typical trading platform? Can you guess what the purpose is of a trading system? I wonder what it might be. I'm sure you guys have no idea. Purpose of a trading platform is to facilitate trading. Wow! Who would have guessed? So, yes, in simple terms, a trading platform facilitates the exchange of various securities. When we say securities, we're talking about, in other words, asset classes. For example, a lot of people are familiar with the term the stock market, right? And that's a generic term that they use for trading, but trading on Wall Street involves a lot more than just stocks. I think more so in the past than now. Another terminology that was kind of more commonplace was the idea of stocks and bonds, right? So it's the stock market and stocks and bonds, right? That's what people outside of the industry, I think that's what a lot of people sort of focused on, and that's the wording that they knew. But you're on the inside now, so let me let you know the nitty-gritty. So when you talk about stocks, you're just talking about equities, which is just one particular asset class security type. So you're talking about buying shares, like I'm going to buy IBM, I'm going to buy Apple, I'm going to buy Facebook, right? You're going to buy shares in those companies. I did another video talking about what stocks are. We're not going to get into that in this video, but that's one asset class. You also have, of course, bonds. So bonds are a form of fixed income security. So there are types of securities where you get a fixed income. So over time, you have income that is being generated by your fixed income security. So typically we're talking about interest. I guess in some ways, to give you an example that most people would understand, think about a savings account as a form of fixed income security, in a way, just to give you the concept. So by you having an account open with a bank, a savings account open with a bank, the bank is going to pay you fractions of a penny every month. I mean, I'm exaggerating, but come on, guys. The interest you guys get on savings account. I actually had a 2% interest savings account before all the craziness of 2020, and a lot of people didn't even know you could get that much. A lot of institutions, like the interest they were given has been absolutely ridiculous. But that's another point. The thing I want you to focus on is just the idea that you're generating income from this savings account. So on Wall Street, there's different types of fixed income securities that investors can invest in and thereby generate some income. Now, you can actually generate some form of income from stocks. You have dividends, but the main component of stocks is that you're essentially purchasing shares of ownership in a company in order to profit from future growth from that company. So you also have derivatives where the value of this asset class or this security type is derived from an underlier. So for example, you can have a futures contract or an options contract, and the value of the futures contract and the options contract is derived, hence the term derivatives, from the underlier or the underlying asset. So for example, I can purchase an options contract which gives me the option, not the obligation, to buy or sell a particular security at a certain price with certain constraints on when I can do so, because there is the concept of the contract expiring. So it could be an options contract to buy or sell a stock. So I can get an options contract on Apple. So the contract could give me the option, not the obligation, to buy or sell Apple stock at a certain price. And that price is fixed based on the contract terms. You also have foreign exchange or FX, which I did a wonderful video on. You should take a look at it. But FX, I look at it as basically you're investing in entire economies. How well a country's economy is doing can definitely have a great effect on the value of their currency. So as a currency trader, where you're trading in FX, you're trying to profit from a positive delta or change between two different currencies. But here's the bottom line. If you would like to trade, you want to purchase stocks, you want to purchase or trade options or futures contracts, you want to exchange currencies, you need a system to be able to do that. If you're going to do that electronically, you need some kind of software to do that. But just a front-end application alone is not enough. There's a lot of components that you're going to need to be able to trade effectively, regardless of whatever currency or whatever asset class you want to trade. The trading system essentially is a technological solution that enables a trader to exchange or to trade various types of securities or asset classes. So you need something where you can enter your order to buy or sell something, and that system needs to have sort of a back end that can take your order and pass it to where it can actually be executed, and then that execution needs to flow back to you as well. And there's a lot more involved, and we're going to cover that all in this video. So let's talk about the technology involved in a typical trading platform. So a couple things to talk about here. Let's talk about operating systems. Typically, back-end systems are going to be Unix-based, very reliable, very efficient, very customizable, and pretty much an industry standard. Quite some time. I've been in this business for over 20 years. I've never seen a trading platform that was not. Let's put it that way. On the front end, you will have a Windows, usually a Windows platform or Windows software or application for your order entry, for your market data, a lot of different components that we're going to get into. And then, of course, because you are doing sort of a collaborative effort, you can't just trade by yourself unless it's a simulator of some sort. You are involving multiple parties, so you need some kind of connectivity. So the next key part of any trading platform is obviously going to be networking. Networking. It's best when it's working. Bad joke, I'm sorry. And then, of course, you have hardware, which is going to be desktops on the client end, servers on the back end. Now, there are also web-based trading platforms, so there is no desktop there, obviously. I mean, clearly, well, not necessarily, because you could. I was going to say clearly there's a desktop where you're running the browser, which allows you to access that website or web-based trading platform. But there may not be, because you could run it on your phone, perhaps, a tablet, perhaps. See the branding stuff? I almost said an iPad. You know, like as if Apple is the only person or company that makes a tablet. But anyway, so it's not about, in that instance, it's not about your hardware. It's more about the internet and your browser, right? But typically, it's going to be a local client. So you're running an application on a desktop, which allows you to do your order entry and things like that. So there's your desktop. And whenever you do your order entry, that order is going to be handled, transmitted, managed via a series of servers, which do a lot of amazing things that we're going to cover later in this video. So there you have it. Those are the fundamental technologies involved in a trading platform. Typical operating system, again, Unix in the back end, Windows on the front end. And then, of course, you're involving networking to be able to connect everything. You know, you're connecting your desktop machine where you're doing your order entry to the order routing trading server that's handling the routing of your orders depending on where they're supposed to go. And then obviously you need connectivity with the exchanges or the counterparties which you're trading with. So obviously networking is a key component of any trading platform. Obviously latency is a very exciting topic, shall we say, when it comes to trading, because time is of essence. The markets can move very, very quickly, and depending on the size of your position, very small movements in price can have and just to give you a little bit of context, one of the parts of all of this that I took ownership of is the closing auction process. So in the closing auction, basically you have a bunch of orders coming in that want to participate in the exchange's closing auction. So that's the final print of the day. When you look at market data, a lot of times you'll see the close price listed. That's going to be the final trade of the day. So let's say the final trade of the day for Apple was at a price of $400. So anyone that participated in that auction, that's what they're going to get. But more importantly, I wanted to give you the context of the kind of money we're talking about. On a good day, I could see $4 billion worth of nominal value. $4 billion is a lot of money. I think on a slow day, might hover around $1 billion. And that's again in one day. And that's also just in one part of the day, the close. That doesn't include all the money that's thrown around throughout the trading day. So understand that $4 billion worth of orders represents $4 billion worth of risk. Because if you have a system issue and for some reason all of those orders don't get executed, no pressure. So let's run through very quickly the components of a trading system. So on the front end, you're going to have an OMS or EMS. Sometimes they're combined. So you have an OMS/EMS. And basically you're talking about an order management system and an execution management system. Perhaps a little bit too complicated to get into in this video, but I would look at it in terms of an order management system. To me, a lot of times can be the simpler of the two. Not necessarily, but when I think about order management system, I think about more so order entry. Now that's really an oversimplification of it, but that's the main thing I think about with an order management system versus a execution management system. I look at it as a little bit more than that in terms of I would expect a typical sell side firm to be more focused on EMSs as opposed to a buy side firm might focus more on an OMS. So on the OMS, you're entering your orders, you're sending it to a sell side firm. Sell side firm is running an EMS, so they are dealing with a lot of what we call parent and child orders. So parent sort of being the master order that comes in, and then we have the child orders that get generated. So I have a client that sends me an order to buy a certain amount of Apple, for example, and I can take pieces of that order and break it up. So let's say 1,000 shares Apple, I can send 500 shares to one venue, another 500 shares to another venue. And then with my EMS system, I have the tools that I need to manage that whole process, to observe and control and modify that process. I can cancel my order, I can modify my order, I can at any time see how my orders are doing and things like that. But the main point is these are the front-end applications that you're going to use to sort of start the whole process. This is where you're entering your orders. This is where you're observing the progress of your orders in either an OMS, order management system, or EMS, execution management system. You also have market data. You have risk management. You have some kind of data warehouse. You also have multiple environments to go through your SDLC process, which is the software development lifecycle. So you're going to have a dev environment, a UAT environment, and a production environment. So you're going to build your code for whatever your trading applications are in your dev environment. So that's where the developers are going to work. And then once the development is complete, they're going to send it over to your QA team or quality assurance team, and they are going to deploy the software into the UAT environment, and they're going to run tests and make sure that the software is running as expected. And then if you pass the certification, then you're going to deploy into the production environment, and that's where it's actually going to be used for trading. These environments can also be very key in the troubleshooting and support perspective, from a perspective of if there's an issue in prod and you need to do some analysis in terms of figuring out why it's happening. It would be nice to have an environment where you can sort of try to replicate the issue. You don't want to be playing around in production, obviously, so that's where UAT would come in. You can have deployed the specific version of the software that's having an issue, and then you can try to duplicate the scenario that occurred in production and see if you get the same results. And based on what you see there, that can assist you in figuring out what the production issue is. Many times you're then going to want to go back to development and say, hey, we identified this issue. Development's going to look into it. They're going to put out a new patch, and then there's going to be a release process where the patch is deployed to the UAT environment, tested there, confirm that it works, deploy it to production to avoid the issue from happening again. You're also going to have compliance. Compliance is, I would say, one of the most beloved departments in the trading world, shall we say. Let's just say you wanna keep on the good side of compliance. You don't want to have any issues there. So let's add compliance. Compliance, basically, they're the watchdogs, making sure we're doing things as we should, so we can avoid running into some problems with the SEC, for example. There are certain rules that we have to abide by, industry rules, and if we violate these rules, the firm can be fined. There will definitely be some serious consequences. So we want to make sure the firm is abiding by the rules and regulations, and that's where compliance comes in. So compliance is going to be utilizing certain surveillance tools that allows them to monitor what's happening in the trading system to make sure that we are always operating within the guideline. And if we're not, they need to be able to identify that and apply corrective action so that we get ourselves back. You're also going to have position management systems, as well as some kind of security master. So basically, the position system or systems basically is going to monitor your positions. So for example, beginning of the day we were flat, we didn't have any positions in any stocks. We go out there to the market and we purchase 1,000 shares of Apple, and then we sell 500 shares of Apple. So at this point, we have 500 shares of Apple, right? We purchased 1,000, we sold half of what we purchased. So of course, we ended up with half of what we purchased. So the current position is we're long 500 shares of Apple. So we need some system to track that throughout the day, so we know where we stand. That's also going to tie closely with your risk management systems. So you're going to have some kind of systems that's going to track what's happening and what exposures are currently out there. So, for example, you might want to limit how large of a position that your various trading desks can have. I mean, for example, I don't think you'd want to just allow any trader to have like 50 million or 100 million or 200 million shares of whatever they want, and end up playing around with $50 billion or something like that. I mean, that could be very, very bad if things go south. So the exposure to the firm a bit high. So the firm needs to determine what are acceptable levels of risk, and based on those decisions, you're going to have a risk management system that's going to make sure that the firm stays within those bounds. So that's going to tie closely with your position management, because position management is going to data in terms of what your exposure is. So you have various desks that are trading the same security. Overall, how many shares of Apple does the firm have? And what is the financial value behind those shares? So what is the cost behind those shares All right, so I think we covered all of the basics. And now it's time to move on to the nitty-gritty. Time to lift up the hood and see what's underneath the trading system and how all these various pieces work together. And you're going to learn that right here on Carlisle Speaks Wall Street. Stay tuned. Vigits, aroma, arrivederci. Oh, make sure you click on the like button, subscribe, and smash that bell. Thank you.